This is what California will tax when you retire and what it won't. Seniors in the state face income tax rates up to 13.3% on most retirement income, but Social Security benefits are completely exempt and several property tax programs can save thousands every year if you know how to use them. California doesn't tax your Social Security retirement benefits, not a single dollar of them. Railroad retirement Tier 1 benefits get the same treatment. While more than 10 states including Colorado, New Mexico, and Vermont still take a cut of Social Security income, California leaves it alone entirely, which makes the state one of the better places to retire if Social Security makes up most of your income. The federal government is a different story. Washington still taxes Social Security benefits using rules that haven't changed in years. Single filers with combined income between $25,000 and $34,000 can see up to 50% of their benefits taxed, and above $34,000 that jumps to 85%. Married couples filing jointly hit 50% taxation between $32,000 and $44,000 of combined income, and 85% above $44,000. Combined income means your adjusted gross income plus non-taxable interest plus half of your Social Security benefits, and those federal thresholds are still in place for 2025. Every dollar you pull from a traditional 401k, 403(b), or IRA gets taxed as regular income in California. The state offers no deduction or exemption for retirement account withdrawals, which surprises people who spent decades building those accounts specifically for retirement. California's 9 tax brackets run from 1% at the bottom to 13.3% at the top, the highest state income tax rate in the country. Earn over $1 million and you'll pay an extra 1% mental health services tax, pushing the effective top rate to 14.3%. For retirees taking required minimum distributions, those withdrawals can push you into brackets you didn't expect. Roth accounts work differently. Qualified withdrawals from Roth IRAs and Roth 401ks are tax-free because you already paid taxes when you contributed, and those distributions don't count as taxable income for California or federal purposes. Government pensions, private pensions, and military retirement income all get taxed as regular income at California's 1% to 13.3% rates. Early retirement distributions face a 2.5% tax rate. Investment sales during retirement create another tax hit because California treats long-term capital gains as ordinary income with no preferential rate like you get federally. A dollar from capital gains gets taxed the same as a dollar from your pension or 401k, which means selling appreciated stocks can push you into higher brackets faster than you'd expect. President Trump signed a new law July 4, 2025 that created a temporary $6,000 deduction for anyone age 65 or older, available for tax years 2025 through 2028. Married couples where both spouses are 65 or older can deduct $12,000 total, and this bonus sits on top of the regular standard deduction and the existing extra deduction seniors already get. The catch is income limits. Single filers earning more than $75,000 in modified adjusted gross income see the deduction phase out at 6% per dollar over the threshold, disappearing completely at $175,000. Married couples filing jointly start phasing out at $150,000 and lose the full deduction at $250,000. A single filer making $85,000 would be $10,000 over the threshold, reducing the deduction by $600 to leave them with $5,400 instead of the full $6,000. You can claim this whether you itemize or take the standard deduction, but you need a work-authorized Social Security number and you can't use married filing separately status. The base standard deduction for 2025 is $15,750 for single filers, $31,500 for married filing jointly, and $23,625 for heads of household. Seniors 65 and older get an additional $2,000 if single or head of household, up from $1,950 in 2024, and married couples get an extra $1,600 per qualifying spouse, up from $1,550. Stack everything together and a single senior can deduct $23,750 total, which is the $15,750 base plus the $2,000 age addition plus the $6,000 bonus. Married couples where both are 65 or older reach $46,700 in combined deductions. The state and local tax deduction cap also jumped from $10,000 to $40,000 for taxpayers earning below $500,000 in adjusted gross income, running through 2029 and helping those who itemize. California gives seniors 65 or older by December 31 an additional exemption credit on state income taxes, and each spouse can claim it if both qualify. For 2024, the exemption was $149 for singles and married filing separately, or $298 for married filing jointly. Seniors can double the standard exemption to $298 for singles or $596 for married couples. The state also offers a senior head of household credit for those who qualify. The California Earned Income Tax Credit is available to low-income workers making up to $31,950 annually as of 2024, and depending on income and family size, this credit can slash your state tax liability by up to $3,644. Seniors still working with earned income can use this, and if you qualify for CalEITC with a child under 6, the Young Child Tax Credit adds up to $1,154 per return for 2024. California's average property tax rate is 0.71% statewide, relatively low compared to other states, but the average homeowner pays $4,694 because home values run high. Proposition 13 has been in place since 1978, capping annual increases at 2% and limiting the tax to 1% of assessed value plus local and county taxes. Long-time homeowners pay far less than their current home values would suggest because their assessed values are locked in from purchase, while newer residents or people who recently moved face much higher bills based on current market prices. The Property Tax Postponement Program lets eligible seniors defer current year property taxes on their primary residence if they're 62 or older, blind, or disabled, with household income of $55,181 or less based on 2024 income and at least 40% equity in the home. This income limit went up from previous years, expanding eligibility, and the program now covers manufactured homes, though floating homes and houseboats don't qualify. The postponement functions as a loan with 5% simple interest per year computed monthly. A lien goes on your property and the total accumulated amount plus interest comes due when you sell, move out, or die, unless a qualifying spouse or registered domestic partner continues living there. You can't postpone delinquent or defaulted taxes with this program, those remain your responsibility, but delinquent amounts get added to what you owe when calculating the equity requirement. Applications run from October 1 through February 10 each year. For the 2025-2026 tax year, that window is October 1, 2025 through February 10, 2026. Funding is limited and distributed first come first served. During the 2024-2025 tax year, California homeowners postponed over $6.8 million in property taxes. The California State Comptroller's Office administers the program at 800-952-5661. The basic homeowner's exemption cuts your assessed value by $7,000 if the property is your principal residence as of January 1st Street. Apply with your county assessor by February 15 and you get the full exemption for that year. California voters approved Proposition 19 in November 2020, and the base year value transfer provisions went into effect April 1, 2021. Seniors 55 or older, the severely disabled, and wildfire or natural disaster victims can now transfer their current property's taxable value to a replacement primary residence anywhere in California, up to 3 times during their lifetime. The old rules under Propositions 60 and 90 allowed one transfer and restricted you to moving within the same county or to certain reciprocal counties. Proposition 19 removed those location limits completely. There's no cap on replacement home cost, but if it costs more than your current home you'll adjust your tax base upward by the difference, and if it costs the same or less you keep your same low taxable value. Here's how it works. A senior couple owns a home valued at $600,000 that they originally purchased for $200,000, paying $2,200 yearly in property taxes based on the lower assessed value. They can sell and buy another $600,000 home anywhere in California without a property tax increase, saving $4,400 per year if they move across county lines where the new tax base would normally hit $600,000. Buy an $800,000 home instead and their new tax base becomes $400,000, which is their original $200,000 base plus the $200,000 difference between the new and old prices, still saving money compared to full assessment at $800,000. The California State Board of Equalization tracks usage statewide via Social Security number. Only one spouse needs to be 55 or older when you sell your original property. Each person gets 3 transfers, but typically only one gets claimed per transaction, and you must purchase the replacement within 2 years of selling while both properties serve as your principal residence. The inheritance provisions of Proposition 19 took effect February 16, 2021, and this is where families took the hit. Under the old rules from Propositions 58 and 193, you could inherit your parents' or grandparents' home and keep their low property tax base without restriction. Proposition 19 changed that completely. Now the inherited property must have been the decedent's primary residence and must become your primary residence to get any tax break. Inheriting a second home, rental property, or vacation home, or not planning to live in the inherited home yourself means no exclusion and full reassessment to current fair market value with property taxes reflecting today's prices. Even moving into the home as your primary residence only gets you a $1 million exclusion over the factored base year value, with everything above that cap reassessed to fair market value. This cap adjusts annually for inflation, and for 2027 the amount is $1,044,586. Here's a real-world example. Your parents bought a home in 1985 with a $150,000 base year value, and in 2025 the fair market value is $2 million. You inherit and move in. The first $1 million above the base value gets excluded under Proposition 19, making your new assessed value $1,150,000, which means you'll pay significantly higher property taxes than your parents even though you're living in the home. Don't move in and the full $2 million gets assessed with property taxes reflecting current market values, forcing many families to sell long-held properties because the tax burden becomes unaffordable. This has been particularly painful for families planning to keep properties as rentals or pass them to children who already have homes. What used to be straightforward now carries massive tax consequences. California's state sales tax sits at 7.25%, with local jurisdictions adding up to 4.75% more depending on location, pushing total sales tax to 10.75% or even 12% in some areas. Prescription drugs are exempt and most groceries including produce, baby formula, and non-carbonated sports drinks get a pass, but prepared foods, alcohol, soaps, and detergents all get taxed. California has no inheritance tax and no estate tax. Your heirs won't owe California any state-level death taxes on what they inherit, though federal estate taxes may apply depending on estate size. The property tax reassessment issues under Proposition 19 are separate property tax matters, not death taxes. California's high tax rates on retirement income make planning critical. Roth conversions during low-income years mean paying taxes on the conversion now but getting tax-free withdrawals forever after, which can cut your tax burden significantly down the road. Timing withdrawals strategically by spreading them over multiple years keeps you from jumping into higher brackets in any single year and helps you avoid triggering increased Medicare premiums that kick in based on your income from 2 years prior. Health savings account contributions offer a triple tax benefit if you're still working and eligible. Contributions are tax-deductible, growth is tax-deferred, and withdrawals for qualified medical expenses are tax-free, letting you offset long-term care costs or other out-of-pocket health expenses in retirement. When taking distributions, pull from Roth IRAs before traditional IRAs when possible. Roth withdrawals don't count as taxable income for California or federal purposes, keeping your combined income lower and reducing how much of your Social Security gets taxed federally. Delaying Social Security benefits past full retirement age up to 70 increases your monthly benefit for each year you wait, and if you can withdraw from other sources first while delaying Social Security, you may avoid or reduce federal taxation on those benefits entirely. California's tax treatment of retirement income splits down the middle. Social Security benefits are completely exempt, providing real relief for retirees depending heavily on those payments, and property tax programs like Proposition 19's base year value transfer and the Property Tax Postponement program can save thousands for eligible seniors. Everything else gets taxed at rates up to 13.3%, with pensions, 401k withdrawals, IRA distributions, and investment gains all treated as ordinary income and no exemption or deduction for retirement income at the state level. The new federal senior bonus deduction worth $6,000 per person helps offset that burden for 2025 through 2028 if your income stays below the phase-out thresholds. Knowing exactly what gets taxed and what doesn't lets you plan strategically. Working with a tax professional who understands California's rules, structuring your withdrawals to minimize the hit, and taking advantage of available credits and programs can easily save tens of thousands of dollars over a 20 or 30-year retirement. California offers a desirable lifestyle and leaves your Social Security alone, but almost everything else is fair game.